In today's lecture, we will talk about financial options and their valuation, and this is chapter 8 in your book. And this reminds me, your spreadsheets for the last reading are due in the next class, Monday. Take a wild guess. Okay, how many people have heard about options, call options, put options before? A few of you. How many people know what they mean? A few of you.
Is it like futures or anything?
It is. They are part of the same family but different. Okay, so in this class we only talk about options. If you in a derivatives class, you will also learn about other kinds of derivatives called futures, forward, swaps, etc. Okay, now let me first just describe what is a option. An option belongs to a category of instruments or things that you can have called derivatives. So under derivatives you can have options, and some of you talked about futures, forwards and so on. So under derivatives you can have several kinds of things. The fancy way in finance of saying a thing is calling it an instrument. So there are different financial instruments. All right. When you are in a job interview, if you can use good words and use them at the right place at the right time, that will serve you well. If you are not sure, the worst thing to do is use a good word at the wrong time. Okay, so that will totally mess you up. So make sure you know what you're talking about. Okay, now the reason an option is called a derivative is because it derives its value from something else. All right, so whenever we have any kind of derivative, derivatives are nothing but a contract or a piece of paper. And I'm going to give you an example of what is called a call option. So a call option is a piece of paper, and that piece of paper is a contract or a agreement. It's between two parties. For simplicity, we will call the two parties Party A and Party B. So in a call option, these two parties get together, and I'm telling it to you in a very simplistic way. In the real world, this is a little more sophisticated, but if you understand what I'm saying right now, then everything else later will make sense. So a call option will say something like this. It will say that one party, let's say A, has the right to buy some underlying asset. The underlying asset can be stocks of, say, 4G fertilizer. So this underlying is one share of 4G fertilizer. That's the underlying asset. So on a call option, we will write down several things, but there are three pieces of core information. One piece of information is what is the underlying, and the answer is the underlying is one share of 4G fertilizer. So I'll say one share of 4G fertilizer. This call option will also say that party A has the right to buy a share of 4G fertilizer for rupees PKR 100. And do you think this right is indefinite, or will there be a date by which time this right can be exercised? There will be a date. So if we are creating this contract today, let's say that you are party A, so you have the right to buy, and I am party B. So I am going to be obligated to sell the underlying asset. So we will put a date. Today is 25th or 26th April. So we can say that up to and including 30th June 2012, you have the right but not the obligation to buy the underlying stock for 100 rupees. Then you and I will both sign this piece of paper. Okay, now who do you think pays for this piece of paper? Who is this more valuable to? It is, in this example, it is party A, which is you, because what this piece of paper is saying is that up till 30th June, you have the right but not the obligation to buy the underlying asset, which happens to be one share of 4G fertilizer, for 100 rupees. Now, let's say that we get to 30th June and the market price of 4G fertilizer depicted by S is 120 rupees. Will you exercise the option? You will exercise the option. At that point, you will come to me with that piece of paper and you will say, look, we signed this piece of paper where we made a commitment that I, party B, will sell you this asset for 100 rupees. What is your payoff? So 20, you can then get that asset from me for 20 rupees, go to the market, sell it for 120 and make a payoff at maturity of 20 rupees. So this is your basic call option. It is valuable to party A. Party A is called several things. Party A is the holder of the option. Party A is also called the long party. The party that is in the contract to buy the underlying asset is called long. Is that easy to remember or difficult to remember?
Easy.
Okay, so it's easy for you. Let us see. Do you know what party B is called, Samra? Okay, party B is called the short party. So the short party is the party that is getting into the contract to sell. What does the long party get into the contract to do? Yeah, you just say the last thing that you hear. So the long party is the party that gets into the contract to buy the underlying asset. When this contract is written and signed, at that point, can we say that the long party has the underlying asset? No. It only has a piece of paper, a contract that gives it the right to buy the underlying asset. Now, let's say at maturity, the stock price went down and it actually was 95 rupees. Then will you exercise your option to buy for 100? No. If you still really want the stock, what will you do? You will go to the market and buy it for 95. No point exercising the option to buy for 100. Okay, so this is your most basic scenario. Okay, now this is not a loan. This is, so the contract between you and me, so we'll see this later, but it's a very good question. In this very simple setup, the two parties are you and me. I am party B, I'm short, you are long. Who is this valuable to? Now, do you think I'm going to give this to you for free? No, I'm going to charge for it. Okay, that is called the option price or the option premium. Both terms are used. So let's say that to give you this right, I charge 10 rupees. Is that conceivable? It is conceivable that I charge 10 rupees. How we come up with the 10 rupees we will do later in this chapter. But for now, let's say that we will call this C is equal to 10. What does C equal to 10 mean? That the amount that I charge you, the premium that I charge you for giving you this option is 10 rupees. Now, when I do this, what am I hoping for? No, if I don't want you to buy it, then I won't be at the negotiating table in the first place. Yeah, what would my view on the underlying stock be? Yeah, my view might be that, let's say that the current stock price is 99. That's S naught or the current stock price. My view might be that the stock price will remain at 99 or come down. Okay. Then what's in it for me when I get into this contract? Yeah, I just get 10 rupees. I sell 1 million such options and I have 10 million and I go and party, and if I'm right, then what happens? 1 second. Okay, 1 second. So the question here is about company, not company. Let's say that this transaction is happening outside the context of the company. So the company is 4G Fertilizer. I am Arif Irfanullah. I am writing this contract with you. The company has nothing to do with it. The shares of 4G Fertilizer are trading on the secondary market. Okay, and I am a option dealer. I set up a company called Arif Irfanullah Option Dealership, right? So I am in the business of writing options, and if you trust me and I write this contract and you believe that the stock price will go up, you will come to me, you will pay me 10 rupees, and then on maturity day or somewhere in between, if you come back and want to exercise the option, I will have an obligation to fulfill that. So you come to me and say you want to exercise this option. What will that mean? That will mean that you pay me 100 rupees and I need to give you a share of Fauji Fertilizer. Either do I have to own the share? Not necessarily. I can, if my view is that the price will go down, then what will I do? I will go to the market on that day, buy the share and give it to you. So when I wrote this contract, what do you think my view was, Anusha? So, Serish, Turab. Exactly. So if I am writing an option giving you the right to buy from me for 100, I am hoping for, or I am expecting the share price to go down. What is your thought? Your thought is that the share price will go up. So the long always makes money when the underlying goes up. And the short benefits. What is my benefit? If the share goes down, how much do I benefit? Yeah, I get the premium of 10. Yeah, but the point is that on day 0, when we wrote the contract, do you think I wrote this contract and gave you the option for free? No, so I charged an option premium of 10 right up front. So I pocketed my money on day 0. That's why my business is so great. All I did is wrote this piece of paper. I happen to know the CEO of Fauji Fertilizer who told me that this share kahin nahi ja raha. Right? You don't know that. Okay, so I wrote this option. You believe that fertilizer sector will do well, Fauji Fertilizer will do well. I can just pay 10 rupees and make a ton of money. Okay, so anyway, that's the basics. Okay, so the question, this is a good question. Does party B own the shares or not? Doesn't have to. Okay, so what am I hoping for? I'm the B party. So I can have the share if I want, but if I'm pretty much convinced that these shares are not going anywhere, I charge 10 and then share price goes down. Are you going to come to me at any point? No. So I just take the money and I'm happy. So people who know the markets well make a ton of money using options. Okay, now actually what I have done is spent a lot of time on that basic concept. Almost everything that you see now in the rest of this chapter is based on that concept. So if you are paying attention, then it will be easy. If you are not paying attention, then you will have to watch the video several times if you want to understand this. Okay, what is the most important characteristic of an option? It does not obligate its owner to take any action. Now, in my simple example, who's the owner of the option? Party A, the long party, the holder of the option, the owner of the option, all those terms are synonymous. So it does not obligate its owner to take any action. It merely gives the owner the right to buy the asset. The sell I'll do later, that's a put option. Right now we are just talking about giving the owner of that option or contract the right, but not the obligation to buy the underlying. Okay, so another good question, can A take that piece of paper and sell it? In markets such as the US and other developed markets, there are secondary markets for options. So you can actually buy and sell that piece of paper. In Pakistan, options are traded in what's called over-the-counter market, which means that there isn't a stock exchange or an option exchange where you buy and sell option contracts, but you can go to what's called an authorized derivatives dealer such as Standard Chartered Bank, and large companies do that. They can go and set up an option agreement with Standard Chartered Bank. So those then are not easily tradable. If you can find somebody who's willing to buy that right or that contract, well and good, but not so easy. Okay, so Another good question. The question is that if you, let's say in my simple example, you at time 0 buy a call option for 10. So you are party A, you are long, you buy that call option. So you have that piece of paper that gives you the right but not the obligation to buy the underlying stock for 100 up till 30th June. Okay. Now at this time when you bought the option, the share price was 99. Somewhere in between, the share price shoots up to 120. Do you think that piece of paper that you have is becoming more and more valuable as the underlying stock goes up? It is. Now, if you are operating in the Chicago options market, that's one of the largest options market in the world, and this is a secondary market, that piece of paper is trading like any share. And obviously, if the underlying price has gone up, the value of that piece of paper or that contract has also gone up a lot. And you can actually now sell that piece of paper that you originally purchased for 10. The price of that piece of paper will be at least 20. Right? Let's say that more realistically, since you still have time to maturity, that piece of paper can be now trading for 25. So you can sell that piece of paper for 25. Okay. Now, just as a side remark, why are options needed? At this stage, different reasons why options are needed or used. I've actually given you one basic reason that's not explicitly mentioned here. Options can be used to make money. So if you are speculating and you believe a given stock price will go up, you can either buy the stock. So you can buy the stock for 99, and if it goes up to 120, how much money did you make? Yeah, you made 21 bucks on a 99 rupee investment. On the other hand, if you buy an option for 10, and let's say you buy 10 of these, so your investment again is 100, and when the option price goes up to 25, that 100 rupee investment has now become 250. Which return is better, the return on the stock or the return on the options? So options will give you a hugely multiplied return if you are right. If you are wrong and the stock price goes down from 99 to 98, then if you had bought the stock, what's your loss? Rizal, you buy a stock for 99, price comes down to 98, what's your loss? 1. On the other hand, if you had bought options and the stock price comes down from 99 to 98, what's your loss? What percent? A very basic question. You bought options. Each option was for 10 rupees. You bought 10 of them. And then the stock price, which originally was 99, at maturity, that's 98. What's your percentage profit or percentage loss? I know that. 100% what? Loss. Yeah, so you paid 10 rupees per option. When the option expires, the stock price is down. So will that option do you any good? Can you go to the party that you bought the option from, that's me, and say, Sir, zara paise wapis kar de? Right? No, we made an agreement right here. I would have honored the commitment if I had to. But I was right, stock price went down, you were wrong, so you lose money, and you lose a ton of money, you lose all your money. Okay, so the point here is, if you get it right, options can be used to manage, to make money. Options, as we will see later, can also be used to manage risk, and we will see, at this point, just memorize this point. How we do it, you will understand as we get deeper into the subject. Okay, so what if the stock price goes back up? Then it depends. If it goes back up after this date, then doesn't help you.
But what if it goes back up within that specified?
Yeah, within that specified. Yeah, then you just wait till the end, and you hope that at the end the stock price is up. Okay, now let me just finish this point very quick. Sometimes companies can also give employee stock options. So what I've talked about so far is in the context of an option dealer selling or writing options. Selling options and writing options are synonymous. But a company might also say to its senior executives that we are giving you the right to buy our company shares for 100 rupees. So 4G Fertilizer might give its senior management the option to buy underlying shares for 100. Why? Because then the management will be incented to do everything possible to make the company perform well and increase share price. And then if the share price is up to 150 and the senior management has the right to get shares at 100 rupees from the company, that obviously is a big bonus for the senior management. To help with capital structure decisions, especially when convertible securities are used, this is, just take that as a given right now, this is beyond the scope of what we need to get into. Okay, so I have already talked about a call option, and in case the concept hasn't sinked in fully, we will say this again. A call option is an option to buy a specified number of shares of a security within some future period. All right, so we've done this. What is in the example that I have given so far, what is the exercise or the strike price? Yeah, it's written as X, so X is equal to 100. This is the price at which the long party has the right to buy. The price stated in the contract at which the security can be bought. Will the security necessarily be bought at this price, Salman? Will the security necessarily be bought at this price? Not necessarily, it depends. Okay, what is the option price? This is the price that the long party pays for the option. In my simplistic example, what was the option price? 10. It's written as C for a call option equals 10. Upfront, this is how much you, the long party, paid for the option. All right, what's expiration date? Umar? Raza. Expiration date in my example. Yeah, the expiration date was 30th June, and what was the significance of that date? Exactly. So the long party, that is you, have the right to buy the underlying asset till that date. So for example, if till that date the stock price was 99, and then on 1st July the stock price shoots up, does that help you? No, you'll just be kicking yourself, but it doesn't help you. Okay, yeah. Very good. So this actually is a fundamental point, that the closer you get to maturity date, that obviously is not good for the option holder. So if the stock price is 99, 5 days before, or let's say 1 day before expiry, and the exercise price is 100, what does it look like? It looks like the option holder will not get any money. So in the secondary market, what do you think the value of the call option is that you bought for $10 or 10 rupees? It will be close to zero. Yeah, so the closer you get to expiration, the less valuable the call option becomes. Okay, good intuition. What is the exercise value? This is also called the payoff. It's the value of an option if it were exercised today. So in my simple example where I said that, let me just work up here, on day 0, the stock price was 99. The exercise price on this option is 100. Let's say that it expires on 30th June, and midway, let's say that on 1 June, the stock price has now gone up to 110. What do you think the exercise value is? Tariq? Hussein. What's the exercise? Read the definition and tell me what's the exercise value. Today we are sitting, it's 1st June. Can you read this loudly? Today is 1 June, and I've told you the stock price is 110. If you were Samra, you would just say 10. Right? Okay, why would you say 10? Okay, next. Yeah, can you read the English over here? Okay, so the value of an option if it were exercise today, which is the current stock price. What's the current stock price? 110, and that, as was diligently pointed out, is a minus sign. The strike price is 100, so the exercise value is 10. So if you were to exercise on this day, the value of that option is 10. Okay. All right. What's a covered option? An option written against a stock held in an investor's portfolio. So this is a fancy term or a fancy expression. All this means is that in my simple example, who wrote the option or who sold the option? B. So that was me. I sold the option. If I sell the option, but at the same time I have that share. So let's say I sold options on 100 shares of 4G fertilizer, and I actually have those shares, so that if the share price goes up, I don't have to go to the market and buy the share at a high price. So essentially I'm covered, and hence this sort of a call option where I sell an option when I own the underlying share, this is called a covered option. So an option written against a stock held in an investor's portfolio. So the question is there a limit? Okay, now obviously when we sell the contract, that contract will specify whether this contract is for 1 share or 100 shares. Typically a contract is for 100 shares. Okay, but it has to be mentioned. Why? If it's not mentioned, then what can happen? Remember, so you and I signed this contract today. On 10th June, if it's not specified how many underlying shares, then what will you want to do if the stock price is 150? Yeah, it would not make any sense. You can't, as in we have to agree on how many underlying shares there are. So that will also be written on the contract. So the contract will say 1 share of 4G fertilizer or 100 shares. So it needs to be mentioned. So what do you think a naked or an uncovered option is? Yeah, if I don't own that share and an option written without the stock to back it up, because here I can have a huge loss if the share price goes up. If the share price goes to 200, as recently happened with 4G fertilizer, okay, then what will happen? You can come to me, show me that piece of paper, and what do I need to do? I need to go to the market, buy at 200, and give you the share for how much? 100. So that's a huge loss. And is there a limit to how much loss I can face, I being the short party? No, the higher the stock price, the greater the loss. So theoretically, it's very high.
But even if it is
Yeah,
selling for 100,
exactly.
so there's still a loss.
It's still a loss, correct? It is still a loss. Yeah, thought is correct.
Then
Yeah, so literally from how much money I need to spend. So with a covered option, it's like I have the asset, so that when the stock goes up, I benefit because the stock price goes up. But then that benefit I have to pass on to the other party. With an uncovered option, I have to go figure out where to get that cash from. Right? And if I can't figure that out, then that nice option company that I set up will go bust. Okay, now read this carefully. Okay, does everybody understand this? All right, now are you long or short? Back your name? Kanza. Are you long or short here? Okay, do you, next to Kanza is? Farzan, do you agree with Kanza? Okay, so you owned this many shares and you sell person B the option to buy these shares at 55 per share. So you are short, and how many, this option contract, so in this option contract, what's the underlying? So it is 100 shares of what? Of GCC. Okay, next to Farzan is Shahir. Is this a covered call or an uncovered call?
since you're owning the share, it's covered.
Yeah, so you own the shares, so this is a covered call. The shares are selling at 53.5 per share on 9th January. So, Turab, what's the exercise value? Remember the definition of the exercise value? So, what are the shares selling for? Okay, and you sell, what's the exercise price over here? The exercise price is 55. And now, is this option worth anything right now? It's not worth anything because will somebody exercise, let's say party B, given that the stock price is 53.5, would party B come to you and say, okay, sell me the shares for 55? If they have any sense, they will not do that, because if they want the shares, they'll just get them in the market. So if an option is not going to be exercised, then the exercise value is 0. You are party B. You are long. In this example, long is B. Okay, you are long. What? Okay, so we'll get to this later. Okay, this is a good question, and I will, if that question is not answered by the end of this lecture, stay back, but it should be. All right, now let's continue with this. What is the maturity date? 14th May. So you sell an option to buy these at 55 per share at any time until 14th May. Now, just as a side remark, when you sell the option to the other party to buy these shares at any time until May 14th. Okay, so very broadly speaking, there are two categories of options. One category is called American option. The other is called a European option. American options have absolutely nothing to do with America. An American option is one that gives the buyer the right to, or gives the long party the right to buy on any day up to and including expiration date. A European option can only be exercised on 14th May or expiration date. Are you trying to think about the logic behind that? Don't think about any logic there. It's just, it's like, what's the logic of being called Rohan? Okay, so the point is, it's just a name. You can, that a European, if an option is a European option, it can only be exercised on maturity date. So if you read this carefully, Sarish, is this a European option or an American option? Yeah, it's an American option because it can be exercised on any day up till and including expiration date. Okay, so you have learnt a fair amount by reading this passage. Okay, so we have done all this stuff. Who is the writer of the option in this case? The short is the writer. That in this example it was you. Okay, you wrote the option. Okay, who is the buyer? Party B was buyer. Why would party B buy this option, Rohan? Why do you think, what was party B's view? Exactly. You go long or you buy an option if you think the underlying price will go up. Okay, so good. You are thinking about, if you are the long party, in general, what would you prefer? American option or a European option? Yeah, if you are a buyer, then it is which option gives you more options, so to speak. An American option gives you the option to exercise any time up to and including the expiration date. Okay, so that is a better option. So exactly. So that will be reflected in the price. An American option would typically be at least as valuable as a European option. An American option can never be cheaper than a European option. Is this a covered option? Yes. Yeah. We've already said this is the American option. What's the exercise value? It's 0 because the stock price was less than the exercise price. Yeah. On the exercise, so the question about exercise value, The exercise value is a value on any given day. So on a given day, if the stock price is less than the exercise price, on that day the exercise value is 0. If the next day the stock price is 56, so if the next day S is 56 and X is 55, what's the exercise value? 1. So it is just simple subtraction. Exercise value is this minus this. Okay, now some more terminology. A lot of this chapter is understanding terminology. An option is in the money if it has a positive exercise value, if it has an exercise value. So if for a call option, if the stock price minus exercise price, if this thing is greater than 0, then the option is in the money. If the stock price is less than the strike price, then the option is out of the money. And just take a wild guess, if the stock price is equal to exercise price, then the option is at the money. Okay, now let's look at this example. A call option with an exercise price of 25 has the following values at these prices. So now what we are saying is, let's say on day 0, and just to help you understand this, on day 0 you sell an option, or let's say that this option is now trading in the market, and on day 0 the stock price is equal to 25, and what is the value of the call option on day 0? It is $3. Let's say that this option expires on day 180, approximately 6 months later. So when the option is sold, the stock price is 25. No, I'm sorry. The exercise price is equal to 25. Is it possible that on day 0 the exercise price and the stock price are the same? It can be. Okay, there's nothing inherently stopping us from that. So now will X equal to 25? Will the strike price remain the same throughout? Yeah, the strike price. So on this contract, what are the 3 core pieces of information? Yeah, so you will be told that it's a share. Let's say that these are shares of Microsoft, just to pick a share, 1 share of Microsoft. What else will be written on this? The price. And let's say that this is 1 January and this is 30th June. Okay, these are the 3 core pieces of information, plus there will be other legal stuff, but those are the 3 core pieces of information. And also whether this is a American or a European. So let's say this is an American option. Okay, now on day 0, we are told the stock price is 25. What's the payoff or the exercise value on day 0? It is 0. And yet the option is worth C is equal to 3. Does that make sense? Why? Why would you potentially pay $3 for an option that is not in the money? Yeah, your view is Microsoft is going to do very well. You are hoping that Microsoft share price over the next 6 months will increase substantially. So rather than buying Microsoft shares, you decide to get greedy. You take your, the small amount of money that you have, and rather than buying just 100 shares, you buy 10,000 options. Okay? So it's your father's money, so you decide that you can do stuff with it. All right. So in any case, so 25 is the situation here. Then 3 days later, let's say the stock price actually goes up. All right. So you are celebrating in your dorm room, and what has happened to the market value of the call option? Yeah, it's gone up. Right. So the option is now already worth. Okay, so you text all your friends that, look, in 5 days you have made more than 100% return. Okay, now notice what's the exercise value over here? What's the exercise value? Remember the thing with the minus, right? So the exercise value is going to be 5. So as the stock price keeps going up, the exercise value increases and the market price of the call option, assuming that this piece of paper is trading, if the stock price keeps going up, the value of this piece of paper keeps going up. Okay. Now, let's look at this picture now. Determining the option exercise value and option premium. So all this picture is showing you. Do you understand what this first column is telling you? So this is just giving you different possible stock prices. Okay, what is this second column telling you? The strike price is the same. This is the X. The strike price or the exercise price. Is there any difference between strike price and exercise price? No. They are synonymous. All right. What about exercise value? Yeah, the exercise value is, what's the formula for exercise value? Strike price. Actually, it is the stock price. So it is S minus X. What if S minus X is negative? Then it's 0. So the fancy way of writing this exercise value, your mathematical convention, max of 0 comma S minus X. Okay, does this frighten you or is it rather obvious? Yeah, it is rather obvious, hopefully. Okay, so anyway, that's your exercise value. Notice that what happens to the option price as the market price keeps increasing? So this is also increasing. Now, try to use your brains and figure out what is the definition of option premium. Yeah, so this is the option. Yeah, so this is the option price minus the exercise value. Now, just as a word of caution, in your current book, the definition of exercise premium is this. It's the option price minus the exercise value. But in some books, option premium is used interchangeably with option price. So when and this happens in finance textbooks, sometimes they are slightly different definitions. So will that bother you, or will you be able to, from the context, figure out what's going on? You need to, from the context, figure out what's going on. So that happens a lot in life. All right, so you need to figure things out from the context. Okay, so that's the definition of option premium. At this stage, I'll just let you observe this, and we will understand the explanation later. That when initially the option premium is relatively high, but as the stock price keeps going up, the option premium becomes lower and lower. Okay, so just observe this and we'll discuss why later. Okay. The premium of the option price over the exercise value declines as the stock price increases. This is because there is virtually no chance that the stock will be out of the money at expiration if the stock price is presently very high. Okay, now this is what I want you to really know extremely well, and this is what you are likely to be tested on. This is we are showing three different things here in this picture. You have option value on the y-axis, that's what we call C. What do you have on the x-axis? Stock price. What's this point over here? Yeah, this is your strike price of 25. Now the purple line is called the payoff diagram. What does the payoff diagram mean? It means that you are being told through this diagram that at different possible stock prices, what is the exercise value or the payoff. So the terms payoff and exercise value are synonymous. All right. So notice that from here to here, is the option in the money or out of the money? From here to here, the option is out of the money. And then after this, the option is in the money. And when the stock price is 30, what's the exercise value? 5. When its stock price is 35, the exercise value will be 10 and so on. So what's the slope of this line? 1. So it's a 45-degree line. For every 5 units increase in stock price, there is a 5-unit increase in the payoff or the exercise value. Okay, so there is a 1-to-1 relationship. So the slope is 1. Okay, now what about the market price? So this is the C, the option price. What is this telling you? When the option is way out of the money, the formal term is far out of the money. So is the option price out of the money over here? It is out of the money, but not by much. If the stock price goes down to 5, then what do we say? The option is far out of the money. Do you think an option that is far out of the money has much value? No, because the chances that from now till 30th June, the option will become worth something, that chance or that probability is very low. And since the probability of the option being worth something is low, the price of that option is going to be very low. In fact, it will tend to or approach 0. If the option price, if the stock price starts rising and we are now close to being in the money, then the option suddenly starts having value because, why? Because there is a chance now that by expiration the stock price will be above exercise value and hence will have some value. So notice that as the stock price goes up, the market price will go up. Does it make sense that the market price of the call option is always more than the exercise value? It makes sense because let's say that 3 months before expiration, the stock price is 30. The exercise price in our example is always 25. So we are over here. Imagine that these are American options. So if you exercise, how much will you get right there? You will get at least 5. So the option will always be worth at least the $5, which is the payoff or the exercise value. But why are people willing to pay more than 5? Yeah, because they think that over the next few months until expiration, the stock price will go up. So for that reason, people will be willing to pay more than the exercise value. If the stock price is 0, then the value of the call option will be practically 0. Okay, so maybe 1 cent or, it will be practically 0. Can it be less than 0? No, the call option price can never be less than 0. Why? No, why can the option price never be negative? Okay. Yeah, the point is the option can only, if once you've paid for an option, it can only benefit you. It cannot cause you any harm other than the amount that you've already paid. After that, if the option is out of the money, you don't have to make any payment. That's why an option price can never be negative. Okay, so just some observations on what we've seen. The market value of the option is 0 when the stock price is 0. Market price of the option is always greater than or equal to the exercise value. Market value of the option is greater than 0 even when the option is out of the money. So are all these obvious? Value of the option is steadily increasing as the option price is increasing. You saw that. Options have considerable upside potential but limited downside risk. Does this make sense? What's the limited downside risk when you invest in an option? What's the downside risk? Yeah, it is. You can't lose more than the option price that you paid. What about how much can you gain? Yeah, you can gain, if the stock price keeps going up. But both returns and losses are magnified. So let's see if you can do this. And whether or not you are a finance major, one of the most basic things you need to be able to do is calculate your return. Okay, and for some strange reason in the past, people stumble on this. Okay, you buy STI, so that's a stock, at $30, and the price goes up to 40. So is it obvious that you have a 33% return? All right. Instead, you bought a call option and the price goes up from 7.5 to 16.5 per option. Okay. So the point, this is on the example that we just saw. When the price was 30, the option, what's this 30, the stock or the call option? The stock. If you go back and look at the table, C will be 7.5. When the stock price went up to, if the stock price goes up to 40, C becomes 16.5. So if you had bought the option instead, then from 7.5 to 16.5, the return is 120. Okay, what if the stock price goes from 25, from 30 down to 25? Then if you had the stock, how much would you lose? You would lose 17%. And if you have the option, then how much would you lose? 60%. So notice that so the losses and gains are both magnified when you play with options. Okay, what are some factors that affect the value of a call option? Market price versus strike price. The higher the market price, the higher will be the option's value. This is the market price of what?
Stock.
Yeah, so this is what symbol have I been using for this?
S.
Yes, for market price or stock price. The higher the stock price, the higher the value of the option. The level of the strike price. The higher the strike price, the lower the option's value. What does this mean? Let's say that I have two options on the same stock. Okay, so both cases the stock is Microsoft. So two options, one is called option A, the other is called option B. In option A, the strike price is 25. In option B, the strike price is 30, and both expire on 30th June. Given the same expiration, which option do you think you would pay more for? Where would C? Yeah, A would be worth more. Why? Because the right to buy something cheap is more valuable than the right to buy something at a higher price. So if your option is, so A is more valuable. In other words, the lower the strike price, the more valuable the option. What about the length of the option? So take again two options, A and B. Both are similar, so the same underlying share, the same strike price, but this option A expires on 30th June and this one expires on 31st August. Which option will be more valuable? Yeah, the one that expires later will be more valuable. Why? Yeah. Your name? Malik. Why will option B be more valuable?
Because you have more time and the stock price can go up.
Exactly, because there is a greater chance that Microsoft shares will go up if you have more time. Okay, so is this statement obvious? The longer the option period, the higher the option price. Okay, now this is interesting. Stock price volatility. Okay, so how do you understand let me just erase this. What does stock price volatility mean? Exactly. So high volatility means that the stock price fluctuates a lot. So let me just explain this over here. So volatility. Let's say you have now two options. One is on shares of Microsoft. The other option is on shares of General Electric. Both have the same strike price and both have the same maturity date. And let's say that when you buy the option, both stocks have the same price. However, if you look at the past performance of Microsoft over time, Microsoft shares have performed like this, and General Electric shares have been like that. Okay, where this is the time axis, this is the share price. Which share is more volatile? Clearly, in my simplistic example, Microsoft is more volatile. Now, where do you think, these are both call options, they are both pieces of paper, which call option will be more valuable? On Microsoft, the call option will be more valuable because if this is 25 and you are, let's say you are here right now, given the volatility of Microsoft shares, the chances of making a lot more money are higher. Whereas with GE, which happens to be more stable, the chances of benefiting from the call option are lower. Make sense? Okay, now here is the beauty. Options have a one-sided payoff. Once you've paid a certain amount for the option, can you lose? So all the potential loss doesn't hurt you, other than the option price that you've paid. So that's why we say that options give you a one-sided payoff. Does that term make sense? One-sided payoff. You only benefit from the up movements. You don't lose because of the down movements.
But the price of the option.
No, you will never have other than the option premium, you will never, as a long, you will not lose money beyond the premium. So the question now is this: the premium that you would pay for Microsoft options versus the premium that you pay for GE options, where will you pay a higher premium? So you will pay a higher premium for Microsoft options because the chances of making money with Microsoft options are higher. All right, so that's the simple point. Okay, so we've done all this.